For a long time, corporate sustainability has felt a bit like the Wild West, right? A lot of talk, but not a lot of common rules. Well, that's all changing. A new global standard is here, and it's creating a shared language for how companies report their impact on the world. So in this explainer, we're going to learn that language, starting with the key terms you absolutely need to know.
I mean, how do you really know what's going on inside a company? How do you tell the difference between genuine progress and just, greenwashing? The answer is a common rulebook, a shared language that lets us make real apples to apples comparisons. And these new standards, they're writing that rulebook as we speak.
Okay, first things first. Before we can even begin to talk about sustainability, we have to understand the company itself. How does it work? What does it do? How does it actually create value? This is the foundation for everything else we're going to cover. At the very heart of any company is its business model. You can think of it as its blueprint. It lays out how an organization takes inputs, stuff like raw materials, and through all of its activities, turns them into outputs, like the products it sells. And that, in turn, leads to outcomes, like profit. It's the whole story of how a car company makes a car, or how an agricultural business gets food onto your table. Now, what's really interesting here is how you can see that flow in action. Let's take that agricultural company. The inputs are the crops from the field. The activities are all the processing and packaging. The outputs, that's the packaged food sitting on the grocery store shelf. But, and this is the crucial part, the final step is outcomes. That's the actual impact, generating revenue, maybe gaining market share. See, the product isn't the end of the story. The value it creates is. But here's the thing. No company operates in a bubble. Its real impact stretches way beyond its own factories or offices, and that's where the value chain comes in. This is the entire journey of a product, from the very first spark of an idea all the way to what happens to it after you're done using it. The whole shebang. Just think about the apparel industry. A company might just design and sell clothes, right? But its value chain? That includes the cotton farms, the dye houses, the sewing facilities, the retail stores that sell the clothes, and even the recycling centers that handle them at the end. Sustainability has to be looked at across this entire massive network. So we get the company and we get its giant network. But what sustainability information is actually important? I mean, a company could report on thousands of different things. So how do we figure out what's truly worth sharing? The key, and this is really the whole point, is connecting sustainability directly to the financial bottom line. We're not just talking about feel-good numbers here, we're talking about information that could genuinely impact a company's cash flow, its ability to get a loan, or how much it costs to raise capital. So when an automaker reports a big jump in EV sales, that's not just a green talking point. It's a powerful signal about its future revenue. And this brings us right to the idea of a disclosure topic, because this isn't a one-size-fits-all situation. A risk that's absolutely critical for one industry might be totally irrelevant for another.
And this is where it gets really practical. For an apparel company, a key topic is going to be labor conditions in its supply chain. For a biotech firm, it's all about drug safety. For an automaker, it's the average fuel economy of the cars it sells. Each topic is perfectly tailored to the unique reality of that industry.
Okay, so we've got our topics, but how do we decide if a specific piece of data is important enough to report? Well, the standard for that is a concept called materiality, and the test is actually pretty simple. If this information was missing or if it was wrong, could it change an investor's decision to buy, sell, or hold? If the answer is yes, then it's material. Simple as that. And this just makes it so real. An actual apparel company decided that finding a 20% rate of non-compliance during its supplier audits was material information. Now, that's not just a number on a page. That is a significant risk. It's something an investor would absolutely 100% want to know about. It really shows how this abstract idea has very real consequences. All right, so we've got all these different concepts. Now let's see how they all build on each other to create a complete reporting system, the actual rulebook and the final report that comes out of it. And here it is, the IFRS Sustainability Disclosure Standards, which are issued by the International Sustainability Standards Board, or ISSB for short. This is the common language, the global rulebook we've been talking about. The whole goal is to get companies all over the world reporting this stuff in a way that's consistent and comparable, just like they've been doing with their financial numbers for decades. So where does all this new information actually go? It gets integrated right into what are called general-purpose financial reports. And honestly, this is a huge shift. It means for the very first time, sustainability disclosures are going to sit right there alongside the income statement and the balance sheet, all in one complete package.
So we've gone over the what and the how. But now let's talk about the who. Who is all of this for? Who is the actual audience for these super detailed reports? The standards are very, very clear about this. The primary users are the people making the big financial decisions. We're talking about investors, both current and potential ones, plus the banks that lend money, and any other creditors who need to figure out how risky a company is. Let's break that down for a second. An investor needs this information to decide, should I buy more of this stock, sell what I have, or just hold on? A lender is using it to figure out, is this company a safe bet for a loan? And creditors need it to know if they should extend a line of credit. Every single piece of data is designed to help inform these major financial decisions. So what are they looking for when they read these reports? At the end of the day, it's all about understanding risk and opportunity. For instance, an investor looking at a car company wants to see hard data on its switch to electric vehicles. If progress is slow, that's a risk. If innovation is happening fast, that's an opportunity. And both of those scenarios directly affect the company's future value.
Okay, finally, let's look at the practical side of all this. Reporting on the future is hard, so what tools are out there to help? And what happens when these new rules meet the messy reality of the real world?
One of the most powerful tools they have is something called scenario analysis. It's basically a very structured what-if exercise. It helps a company and its investors think through how it might perform under a bunch of different possible futures, which is especially useful when you're dealing with huge uncertainties like climate change or big regulatory shifts. And what's brilliant is just how flexible it is. A biotech firm might use it to model the impact of new drug pricing laws. At the same time, an agricultural company can use climate scenarios to project how future droughts could wreck its supply chain. It's the same tool, just applied to completely different risks. But what if a company just can't get the data? The standards actually have a built-in reality check for this, and it's called impracticable. If, after making every reasonable effort, it's truly impossible to meet a requirement, like, say, a biotech firm can't disclose full patient data because of confidentiality laws, the rules acknowledge that reality. So, we have the business model, we have the value chain, we have the crucial filter of materiality, and we have a global rulebook. It's a whole new vocabulary for talking about business. And the big question that leaves us with is this. Now that everyone is starting to speak the same language, what new and much deeper conversations are we going to have about what a company is truly worth?